how risk slipped into the background. Nothing dramatic announced its departure. No warning sounded. Risk did not disappear. It simply stopped commanding attention. And that quiet shift changed everything. To understand how risk faded into the background, we need to look at how familiarity reshapes perception. When systems endure repeated stress and recover quickly, danger begins to feel routine. What once demanded caution becomes expected. Risk loses urgency not because it is gone, but because it has become normal. Institutions adapted to this comfort. Risk management remained active, but its role softened. Exposure was monitored, modeled, and reported, but rarely feared. Losses were anticipated, absorbed, and explained. As long as outcomes fit within expectations, concerns stayed muted. Markets reinforced the transition. Volatility was framed as noise. Drawdowns were treated as temporary. Recovery became part of the narrative. Investors learned to look past disruption and focus on continuity. Risk was no longer a threat. It was a feature of participation. Regulators absorbed the same signal. Indicators remained within bounds. Stress appeared manageable. Oversight focused on ensuring consistency rather than questioning assumptions. When risk behaved predictably, it felt controlled, even if its presence was constant. This normalization changed behavior subtly. Decisions moved closer to thresholds. Margins narrowed. Buffers thinned. When risk feels familiar, tolerance expands. The system did not take bigger risks. It treated existing ones as less significant. Early signals were easy to dismiss. Sharp moves resolved quickly. Liquidity returned. Each recovery reinforced belief that risk no longer needed close attention. The background hum replaced the alarm. This was the opening moment. Risk did not grow louder. It grew quieter. And when danger fades into the background, preparation fades with it. Because the most dangerous risks are not the ones that shock the system, but the ones the system stops noticing at all. As risk settled into the background, it quietly reshaped how decisions were made. Exposure was still tracked, but urgency was gone. Conversations shifted from prevention to tolerance. The question was no longer whether risk existed, but whether it remained acceptable. Institutions adjusted their posture. Limits were approached more comfortably. Buffers were optimized rather than expanded. Risk teams focused on explaining outcomes instead of challenging assumptions. As long as losses stayed within modeled ranges, concern remained low. Markets amplified the comfort. Participants grew accustomed to rapid recoveries. Short disruptions became buying opportunities. Fear was replaced by timing. Risk felt temporary, manageable, and almost useful. The system learned to move through instability rather than avoid it. Regulators absorbed the same pattern. Oversight remained active, but probing softened. Stress indicators behaved as expected. Each resolved episode reinforced confidence that risk was under control. Familiarity became reassurance. This normalization created subtle distortions. When risk is expected, it no longer triggers adjustment. Exposure grows incrementally. Alignment increases. Decisions cluster closer together. The system becomes efficient at operating near its limits. Early warning signs appeared, but they lacked urgency. Liquidity tightened briefly, then returned. Volatility spiked, then faded. Each event confirmed that risk was present, but survivable. Attention drifted elsewhere. The deeper change was psychological. Risk stopped shaping behavior. It became background noise. When danger feels routine, preparation becomes complacent even without intention. This is how risk loses its power, not by disappearing, but by becoming too familiar to command action. And when risk no longer commands attention, the system forgets how to respond when it stops behaving as expected. The conflict emerges when risk that has faded into the background begins behaving differently. Not larger, but faster. Not louder, but less predictable. What once felt routine starts producing unfamiliar outcomes. Institutions feel the tension first. Losses remain within tolerance, yet patterns change. Correlations tighten unexpectedly. Liquidity behaves inconsistently. Risk teams struggle to interpret signals that no longer match historical rhythm. What was once background noise becomes distracting, but not yet alarming. Markets react unevenly. Price movements feel disconnected from narrative. Volatility spikes without clear cause, then retreats. Participants hesitate, unsure whether this is a temporary distortion or a warning. Familiar recovery patterns begin to weaken. Behavior shifts defensively. Exposure is reduced across similar strategies. Liquidity is pulled from the same areas. Actions remain rational in isolation, but collectively amplify stress. Risk, long ignored, reasserts itself through alignment rather than scale. Regulators face a narrowing margin. Indicators remain mostly acceptable, yet behavior suggests rising fragility. Acting too early risks challenging the belief that risk is manageable. Waiting risks allowing unfamiliar dynamics to harden. Oversight built on expectation struggles with surprise. Public confidence wavers quietly. There is no dramatic failure to explain concern. Instead, unease spreads from inconsistency. If risk was under control, why does it feel hard to predict? This is the core conflict. Risk that fades into the background loses its warning function. When it changes character, the system is slow to notice and slower to respond. The danger is not that risk returns. It is that it returns in a form the system no longer recognizes. The reckoning arrives when the system finally recognizes what was lost. Risk did not become larger. It became quieter, faster, and harder to interpret. By fading into the background, it escaped the attention that once kept it contained. In response, priorities begin to shift. Institutions stop treating risk as a constant hum and start treating change in behavior as the signal that matters. Focus moves from magnitude to pattern, from size to speed. Risk management regains urgency, not because losses increase, but because predictability declines. Preparation evolves accordingly. Buffers are rebuilt not just for scale, but for surprise. Attention returns to correlation, liquidity behavior, and timing. The system relearns that risk is most dangerous when it feels routine. Markets adjust slowly. Confidence becomes less automatic. Volatility is no longer dismissed as noise, but examined for meaning. Stability is measured by responsiveness, not by how quickly calm returns. Regulators adapt their lens as well. Oversight expands beyond thresholds into shifts in behavior. Familiar indicators are treated with caution. Silence no longer reassures. Stability is questioned even when numbers look acceptable for the public. Trust rebuilds gradually, not because risk disappears, but because it is acknowledged openly again. The system feels less comfortable, but more alert. Looking back, how risk slipped into the background reveals a simple truth. Danger does not announce itself when it becomes familiar. It waits until attention drifts, then changes shape. So what do you think? Are we repeating the same mistake again? How